Warren Buffett once said, "Risk comes from not knowing what you're doing." Indeed, this investment titan knows exactly what he's doing. Born in the heartland of America, Omaha, Nebraska in the year 1930, Warren Buffett's journey to financial dominance started at a very young age. His father, Howard Buffett, was a stockbroker and a four-term Republican U.S. representative. The young Buffett didn't have to look far for a role model. His father's influence was instrumental in shaping Buffett's interest in the world of stocks and investments. As a child, Buffett displayed an uncanny fascination for numbers and business. He bought his first stock at the tender age of 11, investing in Citi's service preferred for $38 a share. Even at this young age, Buffett was not afraid to take risks. He understood that in the world of investing, risk and reward go hand in hand. In 1951, Buffett graduated from Columbia Business School under the tutelage of Benjamin Graham, the father of value investing. This was a pivotal moment in Buffett's life. Graham's teachings had a profound influence on Buffett, shaping his investment philosophy and laying the foundation for his future success. Buffett's early life was a preview of the extraordinary journey that lay ahead. His fascination with numbers and business, willingness to take risks, and the influence of his father and mentor, Benjamin Graham, all played a crucial role in his journey. His path was not always smooth, but Buffett was always prepared to navigate the rough waters of the financial world. Even as a child, Buffett was not one to shy away from numbers or business. He was ready to take risks, setting the stage for a remarkable journey. Buffett's journey took a significant turn in the mid-1960s, with the takeover of a struggling textile company named Berkshire Hathaway. Warren Buffett, already a successful investor, first bought shares in Berkshire Hathaway in the early 60s. At the time, it was a declining New England textile company, but Buffett saw something others didn't. He saw an undervalued asset with potential, and he began acquiring more and more shares. As his stake grew, he found himself at odds with the management. The final straw came when the company's CEO tried to buy out Buffett's shares at a lower price than agreed. Buffett responded in a way that would define his career. He bought enough shares to take control of the company and promptly fired the CEO. This was a critical moment in Buffett's journey. Having control of Berkshire Hathaway allowed him to steer the company away from its dying textile business and towards more profitable ventures. He began using the company's cash flow to invest in other businesses, insurance companies, newspapers, and even a candy company. In essence, Berkshire Hathaway became a holding company for Buffett's investments. It was a unique approach, but Buffett wasn't interested in following the crowd. He had a different strategy in mind: buying undervalued companies, or as he put it, buying dollar bills for 40 cents. This strategy became the cornerstone of Buffett's success. He didn't just buy companies, he bought value. He looked for businesses with strong fundamentals, businesses that were undervalued by the market but had the potential for long-term growth. And he held on to these investments often for decades, reaping the rewards of compound growth. Berkshire Hathaway was just the start of Buffett's empire, a testament to his keen eye for undervalued assets and long-term potential. His approach may not have been conventional, but it worked, and it continues to be a guiding principle for investors around the world. Like any journey, Buffett's was not without its bumps. But as he said, you only have to do a very few things right in your life so long as you don't do too many things wrong. Every investor's journey is peppered with both triumphs and trials, and Warren Buffett, despite his phenomenal success, is no exception. Let's delve into some of the significant highs and lows of his investment career. Buffett's acquisition of the insurance company Geico in the late 80s stands as one of his most celebrated triumphs. He had recognized the potential of the company early on, investing in it heavily as a young man. Years later, he seized the opportunity to buy the company outright, a move that has since paid off handsomely. Another of Buffett's major victories came with his investment in Coca-Cola. Following the stock market crash of 1987, Buffett bought a considerable stake in the company. His faith in the iconic brand, coupled with his patience, led to substantial returns. However, the path to success was not always smooth. One of Buffett's most notable missteps was his investment in the Dexter Shoe Company in the early 90s. Initially seeming like a promising venture, the company's value began to plummet shortly after Buffett's acquisition. Despite the mounting losses, Buffett held on to his investment, a decision he later termed as one of his biggest mistakes. Yet, it is these trials that shaped Buffett's investment philosophy. He learned from his missteps, fine-tuning his approach. He once said, "It's good to learn from your mistakes. It's better to learn from other people's mistakes." And true to his words, Buffett's strategy evolved with each setback, setting the stage for future victories. Buffett's journey was never a straight path to success, but a series of hits and misses that shaped his investment philosophy. As we continue our exploration of his life and career, we will delve deeper into this philosophy and the lessons we can glean from it. Buffett's investment philosophy can be summed up in his own words: "Our favorite holding period is forever." This simple statement is the cornerstone of his strategy, revealing his preference for long-term investments over short-term gains. Buffett is not a trader, he is an investor. He doesn't dabble in stocks for quick profits. Instead, he places his trust in companies that demonstrate value and potential for growth over the long haul. Buffett's approach is rooted in the principles of value investing, a concept he learned from his mentor, Benjamin Graham. In essence, value investing involves buying stocks for less than their intrinsic value. Buffett takes this concept a step further by focusing not just on the price of a stock, but on the value of the company behind it. He seeks out businesses that are undervalued, but have strong fundamentals and promising futures. This is where his famous quote comes into play: "Price is what you pay. Value is what you get." Intrinsic value for Buffett is not just about numbers. It's about the quality of the company's management, its competitive advantage, and its potential for growth. A cheap stock price does not necessarily mean a good investment. Buffett believes in investing in quality businesses at a reasonable price, rather than cheap businesses with no potential. Another key element of Buffett's investment strategy is his insistence on staying within his circle of competence. He only invests in industries and companies he understands. He doesn't chase trends or get swayed by market hype. If he doesn't understand a business, he simply doesn't invest in it. This approach has helped him avoid many investment fads that have come and gone over the years. Buffett's philosophy is not about quick wins or instant gratification, but about patience, understanding, and a long-term perspective. His strategy may not be exciting or glamorous, but it's proven to be incredibly effective. And it's a strategy that any investor, regardless of their experience level, can learn from and apply. Warren Buffett, the man, the investor, the philanthropist. His legacy is not just about wealth, but about the lessons he imparted. Now in his 90s, Buffett stands as a beacon of success and wisdom in the world of finance. Yet, despite his remarkable achievements, he remains committed to a life of simplicity and philanthropy. Buffett, who once said, "If you're in the luckiest 1% of humanity, you owe it to the rest of humanity to think about the other 99%, has pledged to give away over 99% of his fortune to philanthropic causes, primarily via the Gates Foundation. An act of generosity that is as unprecedented as it is inspiring. But Buffett's legacy extends beyond his wealth and philanthropy. It's about the principles and strategies he followed to achieve his success. His approach to investing, often termed as value investing, emphasizes the importance of investing in businesses that are undervalued but have strong fundamentals and excellent long-term prospects. Buffett's life and investment strategy teach us the importance of understanding what you're investing in. He famously said, "Never invest in a business you cannot understand." This principle underscores the importance of knowledge and comprehension in investment decisions. Another key lesson from Buffett's life is patience. He once said, "The stock market is a device for transferring money from the impatient to the patient." In a world that often seeks instant gratification, Buffett's strategy underlines the importance of patience and long-term thinking. His life also reminds us of the value of integrity. Buffett has always emphasized that it takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. In the end, Warren Buffett's story is not just about making money, but about wisdom, perseverance, and the courage to take calculated risks. His life serves as a testament to the power of principled investing, patience, and the value of giving back to society.